I'd like to convene the investment committee meeting, and the first order of business is roll call, please.
Henry Jones.
Here.
Bill Slayton.
Here.
Margaret Brown.
Present.
John Chung, represented by Steve Warris.
Here.
Richard Costigan.
Here.
Rob Fechner.
Good morning.
Good morning. Richard Gillihan.
Here.
Dana Hollinger.
Here.
Priya Mather.
Good morning.
Good morning. David Miller.
Here.
Ramon Rubalcava.
Here.
Good morning. Teresa Taylor.
Here.
And Betty Yee.
Okay, thank you very much. I'd like to take a moment of personal privilege to just welcome our new committee members, Mr. Rubalcava, Mr. Miller, and Ms. Brown. So welcome to your first investment committee meeting. The next order of business is the election of the chair and vice chair of the investment committee. At this time, I'll turn the gavel over to Mr. Slayton.
Let's push my button.
Okay.
Okay, thank you very much. Good morning. We'll now have the election for chair of the investment committee, and I call on Mr. Costigan. Excuse me, Mr. Gillihan. Richard, you know. Too many Richards.
Thank you, Mr. Vice President, or Vice Chair. You almost got a promotion.
We'll get organized eventually here.
With a deep appreciation for his leadership on this committee, I would like to, and I'm honored to nominate Mr. Henry Jones for the chairmanship.
Okay, Mr. Jones has been nominated. Are there any further nominations? Are there any further nominations? Third time and last, any further nominations? Nominations are closed, and these nominations do not require a second. So, with that being...
Elect by acclamation?
Motion to elect by acclamation. And a second. All those in favor?
Aye.
Opposed? Motion carries.
Well,
Congratulations.
thank you. Yeah, I want to thank my colleagues for re-electing me to be chair of the investment committee for another year. With that, we will move to elections for the vice chair. And with that, I need to call on someone. If you're already there. Mr. Slayton.
Thank you very much.
Wait a minute, you just went out. Mr.
Right.
Slayton.
Thank you very much. I'd like to nominate the other Richard for vice chair, Mr. Costigan.
Okay, Mr. Costigan has been nominated for vice chair of the investment committee. Are there any further nominations? Are there any further nominations? Are there any further nominations? Seeing no further nominations, I entertain a motion.
Move to elect Mr. Costigan by acclamation.
It's been moved by Ms. Martha, second by who? Mr. Fechner. Okay, congratulations, Mr. Costigan. All in favor say aye. Aye. Opposed? No, none. So we're going to take about a 5-minute break to move the chairs around. So let's allow that to happen for about 5 minutes. We will now move along to the next item on the agenda as the Executive Report, Chief Investment Officer Briefing, Mr. Ted Eliopoulos.
Terrific. Good morning, Mr. Chair, Mr. Vice Chair. Congratulations on your elections, and members of the committee and new members of the committee. Good morning. Ted Eliopoulos, the Chief Investment Officer for CalPERS. Today we have a very in-depth agenda to review the calendar year 2017 performance and risk and attribution of the PERF. You'll be hearing first from the committee's independent third-party consultants first. We like to flip-flop the calendar year returns. You hear from your independent consultants first, and then you'll hear from your professional staff second, all reviewing the same set of data and returns from different perspectives. In the fiscal year, as you remember, your staff goes first and the consultants go second. So we try and choreograph the presentations to not go over too much of the same material and take different takes. But as I said, the review is quite in depth, and we're getting a bit of a later start than anticipated. So I want to make sure to leave time for that. We did have quite an interesting time in the markets the past few weeks, though, so I thought it might be a good time to reflect a little bit on volatility in the markets as we turn to our in-depth review in just a few minutes. I'll get to these. I have a couple charts just two charts to share with you in that regard, and I'll get to them in a minute. On the big picture, the very first point is looking at this last calendar year returns that we'll be reviewing in depth was a terrific return year for the PERF, 15.7% return for the calendar year. Our equity portfolio alone, as you will hear later, was up 24% during that calendar year time, and all asset classes had positive performance, so an unusually strong return performance for the PERF as a whole. Now, this chart that you see in front of you, you can think of this year's performance really capping an overall very strong period coming out of the global financial crisis. So you can see on the left chart, the 0 point is March of '09 following the financial crisis, and you can see the S&P 500 cumulative data up almost 400% over that time period. And then you can see this last few weeks of volatility at the very tail end of that very long bull market run. For the total plan over that same time period, from the end of 2009 through 2017, the total plan returned a cumulative 98.6% over this time period, roughly 9% annualized over that time period. So a very strong rebound out of the financial crisis over this time period. Asset prices across the board, looking at the various individual asset classes, have really benefited, as we've discussed in many occasions and in many different forums, the extraordinary central bank policies, including zero interest rates and quantitative easing during this time period, coupled with this gradual but very persistent global economic recovery over this time period. In addition to that, what we'll talk a little bit later today is, particularly over the course of last year and the year preceding it, markets have been unusually calm, a very low volatility period that we've talked about from time to time, with measures of volatility, as you'll see in both your consultants and our report, measures of volatility at all-time lows, very low periods of measured volatility during this last 2-year period. Now, looking forward to 2018, last week, we're seeing the beginnings of a market environment that may be shifting. And last week we saw the first major market downturn in several years, ending this period of unusual low volatility that we've been experiencing. In fact, from its peak on just January 26th of this month, or last month, January, the S&P 500 lost 8.7%, that downturn that you see reflected on this chart, through Friday. Our fund as a whole, over that period, experienced an estimated loss of 4.6%, showing some of the value of diversification of our total fund portfolio. Now turning to the second chart, it's always important to remember these periods of volatility and particularly declines, negative volatility, in a larger historical context. This graph shows that a 10% drop in the stock market, and certainly a 10% drop for our plan, is not unusual in the context of this longer historical time period. The blue lines are date back to 1953. We've shown the time period just to give a larger and longer historical context. The blue lines, again, are the U.S. stock market as represented by the S&P 500, and you can see the downturns that have occurred fairly regularly during this historical time period, and we would expect to experience during our time periods that we review. In fact, this last 2-year period has been, as I said, unusually calm. But experiencing a 10% drop in the stock market is something that we should expect to see from time to time, and certainly over the time period of our future ALM expectations that we've just gone through. So that's a bit of context for the experiences over the last couple of weeks. I think looking forward, you'll hear some discussion in depth today on the economies, global economies, the U.S. economy. To preface that discussion a bit, I think what you'll hear is that we have some mixed perspectives from an economic and market perspective going forward. The world economy as a whole, the U.S. economy, the Chinese economy, the economy of India, Brazil, Europe, are all growing more strongly than during other time periods of the financial crisis. And this growth is coordinated really for the first time during this post-financial crisis time period. On the other hand, we're starting to see some late cycle pressures that we've discussed from time to time in this committee, including very early signs of potential upticks in inflation that we'll be talking about. As a result, the central banks across the globe, led by our Fed, have started to shift from the highly accommodative policies that I referenced earlier and we've discussed at length in this committee, that really has supported markets since the financial crisis. In the U.S., really just in the same period of volatility we've been talking about, or I've been talking about, we've seen the 10-year note interest rate increase from 2.4% to 2.8% in this same time period. In fact, today, I think coming down this morning, it ticked up to 2.9% so far in 2018. Rising rates put pressure on valuations for equities and our other asset classes, including private equity and real estate. So it's a mixed economic and financial picture in 2018 going forward. Also important, I think, as we start 2018 from the investment committee's perspective, we need to look at CalPERS, the context of CalPERS and our investment portfolio going into 2018 as well. And this too presents a mixed picture of both positives and challenges, looking at attaining our investment objectives. Entering 2018, CalPERS starts with an approximately 70% funded status. We also have quite elevated valuations across all of our asset classes, and having concluded our ALM process just this last December, we are projecting, as the committee is aware, lower returns over this next 10-year time period, lower than we have in previous ALM cycles. On a more positive note, much more positive note, due to the board's decision to lower the discount rate to 7% over time, we are now forecasting neutral to positive cash flows, taking into account both contributions, distributions, and investment income, which strengthens the fund and strengthens our ability to invest through volatile periods like this, not only not having to sell assets during a downturn, but also to reinvest during downturns. So again, another set of mixed pictures for context for 2018. Now, of course, we can't predict how the year will unfold and how the years will unfold, but it looks like 2018 is more likely to be more turbulent than what we have experienced the last couple of years. And we should expect the return of this volatility as we manage the portfolio into the coming year. So, Mr. Chair, those are my remarks for the morning. Be happy to take any questions or move on to the agenda.
Thank you very much. Yeah, I have one question. Looking at the chart, 1987, that I thought that was the Black Monday, and that was the worst decline ever, but the chart doesn't reflect that being the worst decline ever. So what am I missing?
Well, it was a 30% decline in the S&P 500, and it was topped by the financial crisis during that time period.
But looking at 73? That's declined by 40+%. And I'm just, from what I read, I thought it was the worst ever. So I'm just trying to reconcile it.
It could be endpoints, starting in endpoints for the calendar year in this case.
Okay.
So we'll get back to you to see what, if there are different time periods that refresh your memory.
Okay. Mr. Costigan.
Thank you, Mr. Jones. Mr. Leopoulos, just a couple questions so I can better understand it. So last week, while the markets were roiling, one issue that came out was the fact that bonds and stocks were moving in the same direction.
There you are. I couldn't find you. I was like, so I'm used to looking that way. I was like, where's Richard? Okay, sorry.
Thank you for your support, Mr. Leopoulos.
Yeah, sorry about that. I was like, where's Richard?
So, but just last week, it seemed to be that everybody was caught by surprise. The box was up, but then you had this sort of inverse of stocks and bonds both moving downward, and there was actually nowhere to go. If you were a retail or a short-term investor, and again, we're a long-term investor, so it's different. Just can you opine a little bit on why do we think this is something that the markets had not seen before, was this both moving in the same direction, and just the increased volatility? And I do think you're right, well, I know you're right. Based on everything I am also reading is we're going to see 2018 is going to be extremely volatile, and then looking at a financial report, they're now talking about that interest rates might go to 5%, which will have a negative effect on the housing market. The number of people will step away, and based on the affordability and the fact that wages are still somewhat flat, and we have a closing or a reduction. We don't have, the unemployment is exceedingly low. So we've just got this kind of whirlwind or perfect storm coming. So what did happen? Why did bonds and stocks move in the same direction?
Well. On the first piece, the interest rate environment is reacting to this late cycle concern over wages increasing and signs of inflation. So the market's been waiting a long time for signs of inflation and signs of wages ticking up. So that's one factor. Secondly, our own Federal Reserve, as well as other banks, are taking some of the liquidity out of the market over time, a very well telegraphed move, and those moves are occurring, and the market is putting more and more certainty on future rate hikes, certainly by the Fed, and expectations that other Federal Reserves globally will follow in kind, and that has pressure on rates as well. Lastly, this strengthening economic conditions, the macroeconomic picture that you're seeing, both the reports on the underlying U.S. economy as well as other economies are giving confidence to the growing economic growth picture in the U.S. and otherwise, which tend to stimulate interest rates. Lastly, is the prospect of coming off of high valuations in both asset classes. Now, getting back to your question on bonds versus stocks, both bonds and stocks are entering this period at points of historical high valuation levels. So we're at a point where this race between global growth and inflation will play out perhaps differently for stocks and bonds, but they could play out identically if the market fears that either the growth will be less than forecast and there are risks to the growth forecast, or that inflationary pressures will choke off that growth, which would make stocks and bonds move either in the same direction or different directions. At least this last 2-week period, the market was concerned over both interest rate levels rising, signs of inflation, and perhaps taking some gains off of their equity gains for the past 2 years.
Just a couple more quick. So I appreciate the comment that you made that we've now moved back, we've moved away from cash negative. So these actually become opportunities. So we sort of predicted the volatility coming, looked at that last year when we took up the discount rate, when we looked at the asset allocation. So at least long term, we seem to be somewhat well positioned. In fact, I know Ms. Hollinger is constantly concerned about the cash flow aspect of it. This actually has put us in a positive to look at buy on the dip, so to speak, but puts us in a little bit better cash position.
Puts us in a much better position looking forward, having the certainty of those contributions coming in and being able to forecast neutral to positive cash flows going forward, allow us to take advantage of these type of dips coming, not just in the last few weeks, but into the future as well.
Thank you, Mr. Eliopoulos. Thank you to you and your staff.
Thank you. Ms. Taylor?
Yes, thank you. Thank you, Mr. Eliopoulos. I just had I guess, a clarification point for me. Mm-hmm. So you were talking about wage and interest upticks causing concern, as well as maybe too high valuations. So I guess, so you're saying our wage increase and the bonuses that are supposed to be coming from this tax break and stuff causes interest to go up, which then causes a concern in the markets. Is that correct? Am I reading that correctly?
Yeah, that's a good summary of it.
Okay, so I just have a concern that the market is so disconnected from our working Main Street Americans' wages that an increase in wages causes instability on the market, and I feel like that's an unsustainable path for us. And of course, I'll be discussing that, I'm sure, later as we get into the books here. But I just could you give me a little commentary on that? I
think the key word in the second part of your comments is cause, and I think causation is a tricky word and one to avoid, and I think goes to your point. In terms of how the concerns the market has, they worry about things. Are we into a late economic cycle, and what are the things that sort of temper or choke off a rally, a long-term rally? And one of those is rising wages. Now, there are also benefits to increased wages, both for purchasing power and other parts that are very healthy for the economy as well. So I wouldn't say, and I think you're good to push on the point, I wouldn't say that one causes the other. It's a very complex economy with lots of factors playing. Certainly, though, the fact that, and we'll be discussing this in more depth, and we'll have our CalPERS economist here as well to talk through these issues. In a late cycle, growth cycle, looking at both unemployment, but also there have been a fairly persistently low uptick in wages over time. Investors look at that to see what impact it might have on growth.
Right, right. And I do appreciate that. I get the cause and effect issue. I do think as we look further down the road into our agenda for the day that we ought to really discuss the sustainability of that, because I have also heard and read in any Wall Street Journal or wherever that the market itself considers itself untethered to the Main Street economy, and I think that coupled with this information that I'm going to go away from that word caused, but that you know, the wage increase with the interest makes it seem like we are looking at stifling wages so that we can keep the market calm. And I'm certainly hoping that we don't, you know, perpetuate that in any way.
I think we're looking at a very mixed and challenging period going forward where these big forces are at play.
Okay, thank you. See no further questions. We move now to the consent action item. We have a motion. Move approval by Ms. Mather, second by Ms. Taylor. Yes?
Mr. Chair,
Yeah.
remember, oh, this is 4.
One more. Okay. Been moved to second, so all those in favor say aye. Aye. Opposed? Hearing none, the item passes. Now we come to item 5, consent items. Mr. Elopoulos, you have a couple of points to make there.
Mr. Flynn will be covering it.
Okay.
Good morning, Matt Flynn, CalPERS team member. Item 5D and 5E, unfortunately, have some typographical errors that we wanted to bring to your attention. Those errors will be corrected on the information that gets published on the website. For item 5D, inadvertently, a U.S. dollar sign was used for the Bridgepoint investment instead of what should have been a euro sign. And then in item 5E, the headers for each of the reports are switched, if that makes sense. The content of each respective report is accurate and correct. It's just the header is the wrong header for the content of the reports.
Okay,
and we'll make those 2 changes.
Okay, so those are minor changes, so we will receive the consent items as with those modifications. Mr. Juarez? Yes. You need to, if I could, you need to hit your button. Okay, Mr. Juarez.
Thank you, Mr. Chair, and also congratulations on your re-election as investment chair. I appreciate the opportunity to raise on behalf of Treasurer Chung an item that was part of a letter that he sent to the chair of the board in November regarding divestment from wholesalers and retailers of both illegal firearms as well as the types of ammunition accelerators such as bump stock. That has caused such havoc, including the incident that we saw in Las Vegas. Mr. Chung, in his letter, had asked the board to consider divestment from wholesalers and retailers of those illegal firearms and related accessories that make them into highly deadly weapons. And as such, what I'd like to propose is that the staff return in March with an actual separate item that would be a discussion item that would take up both the extent of our exposure to these types of companies, as well as the pros and cons related to any divestment decision that the board might make relative to those wholesalers and retailers, and would ask, with all due respect, that that be agendized for the March agenda.
Thank you, Mr. Rodriguez. Yes, I did respond to the treasurer that we would be taking this item up on our March agenda. Mr. Costigan, you have a comment?
Yes, Mr. Juarez. I just have a question. I mean,
sure.
In the use of the word illegal, you're referring to guns that cannot be legally possessed in California.
In California.
It's not that we are investing with anyone that makes an illegal gun.
No,
I just want to make sure that that's what we're talking about.
Yeah,
is that
similar, but it could be that they would be legal in other states. And so I want to have a broad discussion as to whether or not this board believes that regardless of whether they're sold here or in other states, we want to have our hand in promoting the sale of such weapons even
Correct.
in other states.
Mr. Wars, I just want to make it clear, when we refer to the term illegal, what we're actually referring to is a weapon that is not, you're able to
That's
legally
correct.
possess in the California.
That's
it's not
correct.
we're investing in companies that that produce illegal arms that are sold around the world. I just want clarification.
That's very much correct, and it's very similar to the same action this board took, I guess it was about 4 years ago, relative to the actual manufacture of such weapons. So.
Thank you, Mr. Wars. Thank you, Mr. Chen.
Okay, thank you, Mr. Koska. Okay,
Mr.
now
Chair?
we move to,
Mr. Chair, if I just,
Yes.
if I could. Our plan in March was to review our ESG strategic plan update. We have received several suggestions for agenda items to take up during that review from the Treasurer's Office as well as the Controller's Office and some other board members as well. I think we've collected up 4 or 5 very important policy discussions. Our plan was to bring that forward in March as part of the discussion around our ESG strategic plan, but we were not planning on having separate agenda items for each of the requests, including the one that the Treasurer's Office outlined today. So I know it's a distinction, but I want to make sure that we're providing a clear response.
but a discussion will occur.
Yes, and we can include the discussion around both the capital exposures as well as the pros and cons, but we weren't planning on having a separate agenda item for it.
Okay. Mr. Juarez.
Again, with all due respect to the staff suggestion, I would ask that it be a separate item. I think, and not to in any way take away from those other items you may be discussing. I can assure you this is very important to the treasurer, and I think his expectation would be that it would be considered separately, that there would be a place you could find it in the agenda, and so for that reason, I would ask that it be held separate from the other discussions.
Well, I think it will be discussed separately. It's just that what I hear Mr. Elapoulos saying, that you have an agenda item with several different issues that will be addressed as opposed to 4 different agenda items. So it will be highlighted. Okay.
If I could respond?
Sure.
I think given that I think it would be the treasurer's intent that we ultimately take this up as an action item, I'll again open it up one more time to say I think having it treated separately in the agenda as a discussion item would be very important to that future discussion. And so merely having it compiled with other things, I think, doesn't do it the justice that I think we would all expect. So again, I would ask the chair to consider having that directed to staff to be a separate item.
Okay, I will consider that. Okay. Mr. Slayton. No. Okay, okay. Okay, now we move to the big item for today, the CalPERS Trust Level Review Consultants Report.
I believe Wilshire will be coming up first.
Okay.
Good morning, Rose Dean, Wilshire Associates, and I'm joined by my colleague Ali Kazemi. Ali and I will be reviewing the portfolio performance as of end of 2017, but before getting into the specifics of the portfolio, I'll just add to Ted's comments on just where we are in terms of the economic and capital markets environment in light of the recent market volatility, as well as update you on the revised asset allocation assumptions. So we'll start with slide 2. And these are the updated Wilshire Associates forward-looking asset class return and risk numbers. And in general, the theme remains the same. We expect muted returns to be continuing in the medium term in terms of asset class returns. And if you compare these numbers to those we presented a year ago, just a few highlights. Equity returns are expected to be about 25 basis points lower across regions. Private equity, which the assumptions are anchored on public equity returns, are expected to earn 55 basis points less. Generally, longer dated fixed income is expected to have lower returns as well, particularly those associated with credit risk. And the return expectations for asset classes that are considered to be inflation mitigating are, on the other hand, slightly higher. So those would be your commodities and your real assets. Moving on to slide 3, I'll just touch on a few key metrics of the current economic environment. First is consumer sentiment. In general, the survey shows that consumer sentiment remains strong, and this is related to expectations of continued job growth and potentially wage growth to come. What was interesting in the January survey is that the motivation for purchase decisions have actually shifted now from discounts on prices to increased optimism for wage and sustained job growth. So you can see that the consumer feels relatively confident about the upcoming economic growth. Manufacturing sector also continues to expand. The index came in at 59.7, and just as a reminder, any reading above 50 indicates expansion. And lastly, in terms of unemployment, the official rate remains around 4.1%, and the broad measure, the U6, is around 8.2% in January. And these figures are widely considered to be indicative of full employment. So in the next couple slides, I'll try to add a bit of perspective to what Ted's already mentioned. But obviously, U.S. equity markets have had 9 straight years of positive return, as we see on the bottom left graph, since the 2008 drawdown. And Wilshire 5000 earned, again, over 20% in 2017. And this is also supported by corporate earnings growth. We saw sort of mid-teens growth in 2016, and that is actually continuing in 2017. In fact, over 80% of companies that have reported earnings so far this year have beat analyst expectations. So the fundamentals there also are quite strong. And on the risk side, and Ted alluded to this, but we'll try to provide a bit of a different perspective here. When you look at 2017, there were only 4 days in the 4 trading days in the year where you had losses of 1% or greater. And there were 0 days in 2017 where the market was down 2% or more. And we've already seen much more activity in 2018 already. And so the point here being, in looking at any sort of measure of risk and volatility in equity markets, we're coming into 2018 at a historical low volatility. So in that sense, what we're seeing in terms of this correction is not that surprising. And my last comment on the economy and the Fed balance sheet is that we already know the Fed has signaled that they will be reducing the liquidity in the market, and this is expected to be about $50 billion per month lower by the end of 2018. And by the end of 2020, the balance sheet would be around $2.5 trillion. This is still quite substantial compared to where we were pre-crisis. I think another interesting variable here is that now that we have a new Fed chair, it'll be interesting to see how he manages this cycle, given the fact that he was relatively uncomfortable with a prolonged low-rate environment and using the practice of using quantitative easing to boost growth. So another source of sort of unknown here. And just a quick comment on the rates market, given the Fed stance in raising rates, and also 2017, we saw some meaningful flattening of the curve. We expect the longer end of the curve to steepen out going forward, and spreads in terms of credit fixed income to normalize to historical levels. So what does this mean in terms of going forward? And I think there are a couple of things that are at play here. One is that we have an economy that's expanding, the labor market tightening, but we also have fiscal policy that is adding additional stimulus to the economy through tax cuts and through additional spending. And that is supportive of the stock markets, but obviously in the longer term, the effects are less certain. And on the other hand, we have monetary policy that's going in the opposite direction, where liquidity is being taken out of the market and rates are expected to rise in response to inflation expectations. So these conflicting policies will introduce uncertainty uncertainty in the capital markets. And this is signaling that this is a correction. No one really expects this to be a sustained bear market, but volatility is probably here to stay. So those are my comments. Before I turn it over to Ali for performance specific data, I will be happy to take any questions.
Okay, so no questions at this time.
Good morning, Ali Kazemi, Wilshire Associates. I'm going to be looking at 2017 performance, starting with slide, I believe, 107. Rose already covered the new capital market assumptions. Slide 107 is intended to show what the new expected, thank you, the new expected risk and return levels are of the target allocation. This is not the strategic asset allocation that was selected, which will be implemented later this year. This reflects the existing implementation. So using these new capital market assumptions, expected return for the target allocation is at 6.1%. Expected risk levels are at 7.4%. If we look at the actual allocation, those numbers are slightly elevated due to the fact that we have a slight equity overweight in the portfolio. And overall, that overweight contributes about 65 basis points of tracking error from an actual allocation standpoint, which is still a very tight range. With allocations in mind, the slide 9 here looks at what the actual allocation is. I mentioned earlier there was a slight overweight to equities. That's at about 4.5% currently within the portfolio to growth assets. That's offset by the underweights to real assets and inflation. And we'll look a little bit deeper into the attribution in terms of how that manifests itself with respect to the excess return. But again, those remain tight levels. From a risk standpoint, not surprisingly, growth leads the way in terms of contribution to volatility in the portfolio. At the current allocations, about 85% of the volatility of the portfolio is coming from growth-related assets relative to the target allocation at 82%. So we'll now flip over to the big book of performance for PERF. I'm going to be focusing on the one-year column. In the executive summary package, some of the commentary there states, 2017 as a steady advance, which I thought is a quite appropriate way to revisit 2017 performance. Monthly returns throughout the year were consistently positive with low levels of volatility, so we were able to advance the portfolio on a very steady basis, and the numbers here reflect that. For the one-year total fund performance, Ted already covered this, but we were at 15.7% relative to the policy of 15.5%, so very strong returns, easily beating the actuarial rate of return of 7.5%. When we dive into the drivers, should be of no surprise that growth assets led the way in 2017 at 23.2% relative to policy of 24.2%. The two main drivers of that between public and private, public equities returned 24%, underperforming the policy benchmark, which we'll dive into a little bit detail in the attribution. But also from a private standpoint, returns were quite robust at 18%. Now those will typically lag public markets when we have such a strong public market return. It is no way an indictment of how the private portfolio is doing on a relative basis. Looking at the other asset classes, each of these would be a standalone highlight in any other year, but given where public equities were, they still do look like they're lagging, but still it's very robust returns coming from income at 7.2% relative to the policy at 6.6%. Real assets gained 8.5%, beating the benchmark handily by over 2%. And inflation came in level with policy at 6.3%, but the overall picture was quite strong across all the buckets. I want to flip to the calendar year-to-date attribution. For the benefit of some of the newer board members, I'll walk through a little bit about the goal of what we look at when we dive into attribution. Really, it's about highlighting the contribution to the excess return across two key dimensions. One is the actual allocation effect. So to the extent that you are overweight or underweight your asset classes, has that benefited the PERF? And then the second component that we look at is how is active management contributing either positively or negatively overall to the performance on an excess return basis. And this is revisiting the entire 2017 calendar year. I'll first start with the actual allocation dimension, which is the first column in that table to the right. As you can see, the overall actual allocation impact is 38 basis points for 2017. That was clearly the major driver of the excess return over that period, which was 25 basis points. And if you move up from the 38 basis point number, you can see that primarily came from two places. First, public equities. Given that we were overweight in public equities, and that was the best performing asset class, that nets you a positive excess return contribution from that overweight. Conversely, when we look at the real assets row, we gained 19 basis points there. That was caused due to an underweight to that asset class, and that asset class underperformed relative to the policy. Now, for context, the real assets sleeve of the portfolio did quite well. It's just that it lagged relative to the overall strategic policy, and so that underweight manifests itself into a positive contribution to the overall excess return, which is a good thing. The flip side, the other dimension that we talk about is active management, and how did that contribute to the overall excess return in the portfolio. We can see that that was a negative 6 basis point contribution for the calendar year. Now, most of that was in the first half of 2017. On another slide, you can look at the fiscal year-to-date attribution and see that active management actually contributed positively over the second half of the year. The main drivers of the negative return happen to be within the growth bucket. Public equities contributed negative 15 basis points to the active management, and private markets contributed negative 38 basis points. Again, not an indictment really of the active management in that portfolio. It's just a reality, one of the challenges of benchmarking private assets to a public equity proxy plus a premium. Going to dive a little bit more into some of the context behind some of the numbers we've discussed. I first briefly wanted to touch on the overall equity markets, which, as we've stated already, were quite strong. The one interesting thing on this chart that I wanted to point out is some of the dispersion that we've seen in the equity markets and how that can affect the portfolio. If you want to first focus on the year-to-date column and look at large caps versus small caps, you can see almost 8% differential between large caps and small caps. And if we think about the way we invest portfolios and look at the 10-year number, typically we would expect small caps to outperform large caps. It's one of the reasons why smart beta has evolved and fundamental investing has evolved the way that it has. So quite a strong dispersion for a one-year period. That can be a challenge from an active management standpoint, as a lot of managers like to tilt their portfolios towards the small cap. And as I mentioned, smart beta portfolios are also tilted towards that factor. So we can see that even during a strong equity market like this, if you have tilts in one direction, that can cause the portfolio to lag on an active basis, which is something we've seen across the institutional space. Similarly, I would say from a growth value standpoint, if we look at the large growth versus large value, small growth versus small value, big disparity there between those two. And a lot of these actively managed portfolios, a lot of smart beta portfolios have a value tilt. So what does that mean going forward? Well, if you believe that markets will mean revert at some point, then you would expect that those tilts would be beneficial from an active management standpoint. It's something that we can track through the attribution itself, and we'll continue to do so. And it'll be interesting to see how 2018 evolves from a mean reversion standpoint. Within the non-U.S. equity market, just wanted to highlight there again, extremely high, robust returns as the continued strong fundamentals within the non-U.S. market continue to drive returns. Weakening dollar has also been beneficial from an international equity investment standpoint. But what really stands out there is the emerging markets, which is at 37.7% return for the year in 2017. Again, that's a portion of the market that's typically less efficient. There can be value found there, and is shown up in some of the active management that we've seen as international equity portfolio active management has been stronger than, I would say, U.S. equity active management in 2017. All that being said, if we actually dive into the growth sleeve of the portfolio, we can see those returns manifest themselves in terms of how U.S. equity did at 21.2%, slightly underperforming the policy benchmark by 50 basis points. Again, if there's a small cap tilt in there, then that is going to be a big driver of why that may be the case. Within international equities, they beat the policy by 30 basis points for a very strong overall return of 24% from the growth sleeve. Flipping forward to just an overall view of the private equity investment space, slide 27 of the Wilshire book. Overall, fundraising in 2017 continued to set record levels as compared to where we left off in 2016. The one caveat there being that the number of funds closed and deals closed actually decreased in 2017 relative to 2016, which has an impact from a pricing standpoint, but also from an impact of how much dry powder is still out there to continue to fund private equity investing going forward. One of the points I wanted to highlight on slide 29 is just the fact that smaller investments comprise the majority of the deals that we saw in 2017. Although I would state, we did also have the biggest buyout fund and the biggest infrastructure fund of all time also funded in 2017. But put those aside, most of the deals were on the smaller side based on the results that we have seen. Rose already touched on where interest rates were in 2017. In terms of how they affected performance on slide 39, we can see that the U.S. income portfolio generated 6.7% return relative to policy of 6%. A lot of that had to do with the flattening yield curve that we saw in 2017, as well as continued spread tightening. So the long-dated investment-grade corporate sector performed very well, and this portfolio has exposure to that. So that is one of the reasons why you see such a strong return for the income-generating U.S. portion of the portfolio. In the non-U.S. space, we continue to see strong stimulus in Europe that is continuing to drive rates at levels where the non-U.S. income portion of the portfolio has performed quite well at 12.6%, easily beating the policy benchmark by 1% in 2017. I wanted to briefly touch on private real estate before we finish off here. The commercial property slide that you see here, I know has been presented in past meetings, continues the trend that we've seen with respect to availability and vacancy rates continuing to decrease, although that's slightly tapering off. But we continue to see a good trend in the real estate sector. From an absorption rate standpoint, all sectors are in the positive. The one caveat there is in the retail space, where in the last period of 2017, that was actually in the opposite direction. But how that is manifested in terms of performance in 2017, again, has been a good story to tell. The overall real asset portfolio, again, beat policy by over 2.1%. That was primarily driven by the private real estate portfolio. The performance there in 2017 was driven by interest rate levels, strong growth in the labor markets, and then just continued strong fundamentals. Not to remiss what we see in the infrastructure space. That easily beat the benchmark. We've seen 18.2% return there. So the combination of real estate infrastructure, all told, has netted the portfolio quite well in 2017. And so that I will pause and see if there are any questions.
Yes, we do. Mr. Juarez.
Yeah, thank you for the presentation. It was excellent. So I'm going to imagine that this time next year, when you give this report and you look at the 10-year, do we lose the entire period of downturn in 2008, and therefore we should expect a much more rosier picture with regard to the 10-year forecast? Will it happen, I guess, in the next report?
I believe
time next year.
Yeah, I mean, I was actually looking at that in preparation last week. That we are getting to a point now where that 10-year number is gonna drop off the 2008, 2009 period.
So how significant will that be? Do you have any sense? If you look at today's 10-year.
It will have a lot to do with how 2018 shapes out too. So
let's assume that we're just stable for the rest of the year.
If we assume, we could probably come back with a hypothetical number if we assume that capital market assumptions stay true and we get the exactly what we assume. We could easily come back and calculate a hypothetical type of performance number. I believe.
We had close to 30%.
Mike.
Close to 30% drawdown in the equity markets. Rose Dean, Wilshire Associates. We had a 30% drawdown in the equity market, so if that rolls off and we assume that equity market forward-looking assumption return meets the target at 6.25%, you will see a substantial bump in the 10-year number just naturally. But again, that has to materialize through volatility that we'll see in 2018.
Thank you.
Ms. Yee?
Thank you, Mr. Chair. So I was struck by the observation about the focus shifting from the discounted prices to wage growth, and I was curious as to, when you view this this recent market volatility, do you think that's more weighted towards positive labor market news, or is it really more attributed to more high-frequency trading, or a combination?
It's a very interesting question. I think when you see market volatility, over the past 10 years, you definitely have seen a proliferation of algorithmic trading, high-frequency trading, exacerbating the volatility. So, these programs are made to anticipate a trend that is happening in the market. So when the market seems like it's going to drop off the cliff, then these algorithmic trading patterns are programmed to actually take advantage of that, and that will tend to exacerbate the volatility up or down. Mm-hmm. So that is definitely a factor. And also we have a lot more products in the market that are levered versions of the instruments that are that existing instruments. So these all will add to the volatility. But I think the question in terms of consumer behavior really has more to do with the fundamentals of the economy, where again, these purchase decisions are driven by their optimism on the potential stability of the job and the future wage growth.
Mm-hmm. Okay. Thank you.
Mr. Costigan.
Great. So, Mr. Junket, I've got a question for you if you'll come up for a second. But I do just but ask you on page 8. Actually, this is so. When I look at the expected return of 6.1, and we're projecting this 10 years out, similar to the question I asked Mr. Iliopoulos. Last week, again, we had this just negative reaction, odd reaction of bonds and stocks moving in the same directions when they're supposed to go in opposite directions, or that's what the theory. And I mean, you watch CNBC and the business shows, and no one can explain it, right? Other than just wait, the volatility. So when you look at the 6.1 and then the target allocation, I mean, because they're close enough. How do you opine as to what happened last week? Because this is based on a set of facts, which, at least the way I read it, what happened last week was once in a lifetime. Now we're talking about it happening going forward.
Well, I think I would say two things. One, in periods of volatility, it is not, it is uncommon, but it's not unprecedented that you will see, asset classes kind of moving in the same direction. And when we talk about bonds moving in a different direction than stocks, we're talking about obviously that bonds being safe assets. But what's I think important to kind of dissect there is this is an anticipation of higher rates, meaning obviously bonds will trade off as rates go higher, so you have that depression on the bond price.
That's the expectation that if rates go up, bonds would trade higher, but that was not the case last week.
No, expectation that the rates will increase.
Correct.
Right, and which means prices will go down in terms of fixed income. But also on the equity side, as rates go higher, the borrowing rates for corporates and governments will go up, and that is negative to the equity markets. So here, the equity market is really recalibrating to a higher rate environment. And that will push both bond markets to, especially in the longer end, to steepen out, and then equity markets to anticipate higher borrowing costs, therefore lower discount rates, and therefore lower equity prices.
And then
Higher discount rates.
When you look at both return rate and the expected risk, does that factor in, for example, with the Feds now, we're talking about 4 rates this year.
Sure.
Next year. Will you be redoing these charts, or is that, I'm sorry.
So these, the capital markets assumptions we saw on slide 2, that does take, in the fixed income assumptions, it does take into account the forward curve. So what's being priced in terms of the rate expectation in the future for the next 10 years is also being priced in here.
Okay, but the December assumptions were forward-looking when we had yet to expect the December. I mean, exactly. And so
it also takes into account the entire historical fixed income market and the break-evens and the yields. So it is it's taking the perspective of the historical markets as well.
Great. And now, Mr. Junkin, just for you, given the markets the past year, would it be accurate to state that similar to the Oklahoma Sooners in the Rose Bowl, that then there was a lot of buildup and hype, and once there was pressure applied, the markets and the Sooners reacted negatively? Thank you, Mr. Jones.
Congratulations, Mr. Costigan, on your vice chairmanship. I appreciate the question.
You don't have to answer.
Solidly answer yes. Well played, sir.
Ms. Hollinger.
Yes, thank you. Thank you for the report. My question is regarding the expectation of the rising interest rate environment. Given the size of the deficit, don't you think that's going to do you think that is going to put a ceiling on how high interest rates are going to go? Could you speak to that?
I wish I could tell you for sure what the answer
I wish you could too.
But I mean, so the facts are we're already at a very high debt level. So
right.
So, but at some point we're also seeing the impacts of additional debt due to tax cuts, due to additional spending, et cetera.
Right.
So at some point the money has to come from somewhere, right? And typically that's borrowing. So when you have to borrow more, you have to pay more. And also when you are looking at a Fed that's trying to control liquidity, the rates are expected to go higher. So yes, we expect sort of the impact of this spending and additional debt to eventually have a negative effect, whether in the form of depreciation of currency or higher borrowing rates, et cetera. And which is sort of the uncertainty here that caused the market volatility that we're seeing now. Having said that, we are seeing very strong fundamentals, like I said, in terms of economic growth. So, can economic growth reach the levels that is required to offset these spendings? That is probably difficult, but hopefully it's not the case.
Okay. Ms. Yee?
Thank you, Mr. Chair. I had a question. This was in your performance analysis on page 17. You referenced the corporate governance program and experiencing a 29.5% performance jump in the fourth quarter and adding value relative to the growth policy benchmark. What's the magnitude of assets under management that we have invested in these right now?
Sorry, what slide were you on?
I'm on. It's actually the it's attachment 2, page 17, of 54.
Attachment 2.
Oh, it's the executive summary, I believe.
Linked to the growth review for the PERF and corporate governance.
Did you say attachment 2, Ms. Yee? Yeah.
Ms. Yee, I'll probably take this question,
okay.
just given my experience.
Right.
And I think I see out of the corner of my eye Dan Bienvenu getting up. It's less than it's $100 million. That program is has been being wound down for some time.
Yeah. Okay.
Yeah.
Yeah, Dan Bienvenu, Managing Investment Director of Global Equity.
yes, that's a program that we wound down due to highly concentrated risks and fees. So that is actually one existing partnership with one security in it that we were very patient in finding a liquidity event. We've actually since found the vast majority of that liquidity event, so you'll very likely not see that in the future, or at least even in smaller assets.
Okay, all right, thank you.
Okay, there are no further questions on that item. Thank you very much. Next up, I guess, is PCA.
Good morning, Mr. Chairman. David Glickman and Alan Emkin from PCA. Our colleague Christy Fields unfortunately couldn't join us today. She's a little under the weather, but she's looking forward to seeing all of you next month. In your packet, we have provided you with a memo describing the real estate markets, describing the real estate portfolio in CalPERS, and a little bit of forward-looking suggestions. In general, as Wilshire described, the domestic U.S. Commercial real estate markets are close to equilibrium in terms of supply and demand. We are seeing, with no big surprise, that the delivery of multifamily assets has continued to be higher than in years past. To Mr. Costigan's earlier comment about increases in interest rates, which may dampen demand for single-family purchases, especially from first-time home buyers, the rental market will be a beneficiary of that. And so in your portfolio, there'll be an offset, if you will. You are not heavily invested in the single-family private real estate business, but you do have good footings in high-quality, well-located multifamily. So your managers have been instructed to pay very, very close attention to occupancy in an asset class where the tenants turn over every year and are tacking towards continuing to keep high occupancy in markets where there's a little bit of pressure on rental rates. Overall, though, the level of new supply and the quality of the assets that you own should give you some pretty good downside protection. Demand continues to be strong for commercial real estate assets that are similar to the kinds that you seek and that you hold. And the reason for that is, among other things, the performance of the stock market and rebalancing by other institutional investors who find themselves underweight to real estate in light of a 24,000 or 25,000 stock market index. And so where they thought they were at 10%, all of a sudden they're at 9%, and so they want to buy some more, irrespective of any other consideration, but to stay balanced. To the credit of your third-party managers and staff who supervise them, discipline has been very much maintained in the real estate acquisitions program. You have plenty of dry powder, but it has been used very sparingly and very judiciously because the rates that have been offered for purchases haven't warranted making the purchase. The returns need to do the job and the role that you've assigned to commercial real estate, and what's being offered right now, in many cases, doesn't show a high enough projected return with enough certainty to chase. And so the managers have not chased. And while we're a little disappointed that the amount of money that was allocated in the last round of commitments, up to approximately $4 billion of new net allocations, has not been spent to any great degree at all, we admire the discipline and the patience that is being shown in this private, illiquid asset class. The increase in rates overall, over time, may give you better access to more properties at prices you would like to pay than what you've experienced over the last 2 to 3 years. There's still plenty of foreign money that is seeking a home in the United States. There are still very favorable borrowing environments in absolute terms for high net worth individuals and publicly traded companies to acquire new real estate. So you still have and should expect during calendar year 2018 plenty of competition for the kinds of things that you want. In terms of the performance of your existing portfolio, you've undertaken a shift over the last several years to align the components of your real estate program with your strategic plan for real estate. And by that I mean almost 80% of the real estate that you own is strategic. It's long-term, it's leased, and it's throwing off positive cash flow. Over the next year or two, it will continue to throw off cash flow. It will continue to be highly occupied in terms of the occupancy rates of the properties. The amount of total return is likely to decrease from what it has been in calendar year 17, 16, and 15, and 14. And the reason for that is while your cash flows will probably be similar, the rate of price increase we don't see growing as fast as it has grown. There will be other things for people to buy, and so with higher interest rates suggesting that fixed income securities may meet the needs of some investors, whereas they've been looking for real estate to do that heretofore. And so in that regard, it may be a slightly more favorable acquisition environment for you, but it's pretty early to tell. One of the things that Rose alluded to was uncertainty, and uncertainty hits real estate markets in a bunch of different ways. While we have a new tax act, we don't know all of the regulations yet, and the devil will be in the details insofar as how those regulations and how they're enforced affects decisions to take up space, which is ultimately the fundamental on which you need to keep a close eye. In terms of the ESG update, Sarah Bernstein will be here next month during the March meeting to describe in a little bit more detail. The top view, the 25,000-foot view, is that real estate continues to be an asset class in which you have a decent to good chance of being able to measure things. And in terms of the work that is being done to identify climate risk and how it affects your portfolio, as well as some of the other measurable criteria, the real estate department continues to make progress towards a time when even more meaningful portfolio construction decisions can arise from the information that's collected from the ESG monitoring programs. With that in mind, Alan and I would be glad to take, Alan has something to add.
Wearing my joint hat of real estate and general consulting, a couple of observations. You've been discussing risk. There's a term that we used to use a lot, but there aren't too many people who remember it. But the biggest risk that we see is what's called stagflation. And that is when you have not a lot of economic growth and you have inflation. And when that happens, everything does poorly. And we haven't experienced that in a lot of people's memory, but that is why you want a truly diversified portfolio that something does well in that environment, and not too many things do. The other challenge is it didn't get addressed, but there are things that are not obvious in the capital markets, and that's political risk. And the world has become a much more uncertain place politically, whether it's Washington or what happened over the weekend in the Middle East. And had the Israeli pilot landed in Syria as opposed to landing in Israel, you might have a world that looks much more precarious today than it did before. Not that that's going to happen, but it's those types of events which are unforecastable, which can take all of these nice assumptions that get developed and throw them out the window. And we live in an environment where the recent volatility is being impacted by so many variables and so many unknowns that anyone who says they know what's going to happen in the next 12 months, let alone the next decade, they're fortune tellers. And it's just important to recognize the limits that we have in our ability to know about the future. And no one's ever proven any ability to forecast where the capital markets are going, particularly in a very short period of time. And to the chairman's question, that volatility that you saw in the equity market, that huge negative that you were concerned about, that was the biggest one-day drop. It wasn't the biggest drop from peak to trough. And that's what really distinguishes that period in 1987.
When we come and report to you, it's become our habit to try to give you some things to identify looking forward to sort of keep an eye on or watch out for. This isn't a formal SWOT report like we do in November, but things that we would point out, and these are things that the real estate team continues to monitor closely and discuss regularly. But in the real estate portfolio, what are some of the technological changes that are going to affect space use? Whether it's sharing of office space or residential, how the residential landlords are now figuring out how to deal with Airbnb among their tenants so as to not lose quality and control over the apartment assets. That's a change that we need to keep an eye on. The difference between online and in-store purchases continues to be of high importance, and there's going to be some execution risk between the store owners who get it and the store owners, the landlords who don't, and the tenants who don't. We would tell you that another risk, which now that your real estate separate account program, which has been successful in the core area, is reaching a certain age, it's important to look at the managers and try to figure out what the succession plan is for some of the bright people who helped deliver terrific gains in the earlier and current years, but are now reaching a point where the next generation in their firms is going to be taking over control, and whether they've been trained and are incented and are as likely to repeat the performance as the folks who started out. Many of your real estate managers are privately held companies, and they are captive to you. You're their only client. And so the idea of succession and planning is an important thing to consider, even though it might not be on the laundry list of the typical real estate risks like occupancy and overbuilding and things like that. The way you've adopted a real estate investment business model forces some spotlight, I think, onto who the folks are who you've delegated the fiduciary authority to actually make the discretion within a box. And so we're coming up on age issues for some of them that staff is continuing to monitor. And I think Paul may be talking a little bit about that going forward. So that's some things to keep in mind. If there are any other questions, Mr. Chairman, we've used a lot of time for 9% of the assets.
We have a couple of questions. Ms. Taylor.
Yes, thank you. Thank you, Mr. Glickman. First of all, I do want to applaud you for including the ESG update in here. And as we go into March, I do look forward to seeing more on that. I thought it was interesting that you included the hurricanes and the fires and the mudslides. And I'd like to see what our measurable problems were with that, if we had any at all. And then climate risk data, if we've got that in the real estate portfolio. But I had one other question. You had mentioned earlier on in your presentation that there was pressure on rental rates. So are you foreseeing that we're no longer able to enjoy higher rental rates? Is that what we're looking at? Or is that a positive pressure? I don't know if you said positive or negative pressure.
No, let me be a little bit more precise. In 2017, second half of the year, and for all of 2018, there are going to be quite a few more new apartment buildings offered.
Okay.
They are built of high quality and in locations that will compete with some of your existing assets. For that brief period of time, the rental rates are likely to be flat or off just a little bit because you'll have more supply than you will have demand. That will take care of itself if you have the patience to be out a year or 18 months or so. And so that was the pressure on rental rates in the short term to which I was referring.
Okay, I appreciate that, and I just want to check. And that was it. Thank you very much.
Okay. Ms. Yee?
Thank you, Mr. Chairman. So to what extent are the managers sensitive to, I guess, the changing nature of our economy and work and all these issues that you've raised relative to the need for space? And occupancy? Because it seems to me this is, in every sector, these are issues that are moving pretty quickly. And I think with respect to just kind of our portfolio, it may be that there are companies and other asset classes that could help inform what we do in real estate relative to those issues?
There are, and I think that both your staff and your managers take advantage of specialists, for example, in the retail area. You've chosen to invest in retail strategically in large dominant malls who have the money and the talent to reconfigure their malls and to deal with the bankruptcies that occur and redo those spaces to tenants who might not be able to have gotten into those malls right now, because remember, your portfolio is defensive. No more than, say, 15% of your portfolio's leases expire in any 1 year. That's one of the reasons why it has a lower volatility than some of the other asset classes. But by using partnerships with very clever, very well-heeled operators like Simon in the mall space, you're able to respond to the changes in a timely way. The other end of your retail portfolio is grocery-anchored shopping centers, and those are still relatively favored in terms of consumer demand and showing up. It's the group in the middle that is having more trouble and getting most of the bad publicity, and fortunately that's not where your portfolio is. In terms of the apartment investments that you have, the managers are offering common spaces. They're offering upgraded technology as a feature of each of the apartments in order to stay competitive with what other brand new developments might be. And again, you have well-heeled managers. By well-heeled, I mean they have plenty of capital available to them. And when they have a project in mind to improve a property, they bring that request to staff with a projection of what kind of return on investment spending another several $1,000,000 might be in that one property, and those are the kinds of things that are encouraged in the annual investment plan process. Office buildings are a little tougher to try to forecast. They're lumpier, they're chunkier. You continue to tilt towards quality and AAA locations, and again, your overall portfolio is only about 31% loan to value. So you have plenty of capacity to reinvest in your properties and continue to keep them current to the extent that there are opportunities to do that on a positive investment basis. I hope that's a survey answer.
No, that's thank you. I appreciate that.
And just to add to that, what Mr. Eliopoulos has done is tried to break down the silos that exist in the organization. And all the technologies you're talking about, to one extent or another, are reflected in either a venture capital investment or a growth capital investment. And there's a transmission of ideas, so that there are no surprises when there is a new technology. And the challenge for the whole investment team is how to integrate the knowledge from those markets to the real estate market, to share in the knowledge that you have available to you to maximize return. And that gives you an advantage over smaller organizations that don't have the depth and do have the silos.
Great. Thank you. I'm glad to hear that. Very glad.
Okay, thank you. Mr. Glickman, you mentioned that the supermarkets were a priority, but what impact is going to occur with all this online shopping? Because that's a growing strategy now, even, you know, with companies acquiring supermarkets to move them to online shopping.
It's going to have an impact. When and how much, I'm not sure. The grand experiment, which everybody's watching, is Amazon and Whole Foods. And to the extent that they're able to automate part of the shopping experience, and you know, it's not just them and supermarkets, but Walmart and Target have also gone into the grocery business. And a lot of the things that people purchase can be ordered online and sort of regularized. When it comes to fresh fruits and vegetables, and it comes to fresh meat and seafood, people still have not been able to figure out how to deliver that satisfactorily and in quantity via remote. And so the challenge for the landlords, the grocery operators, and the landlords who own those centers will be to have enough services in store to warrant people getting there. It's shifting. The shifts on the margin are highly publicized. In terms of the number of dollars of revenue, it's still early days, so we can't quite tell.
Thank you. Mr. Slayton.
Thank you, Mr. Chair. So we're all trying to look out to what's going to happen in the future, whether it be grocery stores, whether it be residential. There's one area that maybe you could comment on, particularly as it relates to office buildings, and that is it looks like the driverless vehicle platform is going to happen sooner rather than later. And if that were to occur, I've read some pieces about development of office buildings where the parking is convertible to additional office space if, in fact, we have fewer people parking their own vehicle in a garage. Can you comment on how that might affect our portfolio and what you see? Is there any defensive steps that we should be taking to be prepared for that?
It's a good question, and my initial reaction to it is garage space is not a high revenue producer. So to the extent that it can be converted to some other use, most garage parking ratios are driven by municipal ordinance rather than market. Mm-hmm. And so the idea that you could recapture some of those spaces since they weren't used by cars anymore and turn them into a more productive use is appealing to me. Whether or not driverless cars and teleconferencing and other remote combinations of creatives becomes effective and how much and how soon, that's going to be another factor influencing that same office tower as to whether it's discrete offices or it's hoteling or it's WeWork or somewhere else up on the collaborative scale. And again, I think at the end of the day, the strategy that your office managers have implemented is highest quality assets, highest quality locations. By highest quality locations, we mean the peripherals as well, the other elements that aren't in your building but are within walking distance to your building, whether it's transportation or retail or entertainment. And I think by continuing to seek those assets, you'll be in a relatively defensive place in your office portfolio compared to some other more far-ranging office portfolios.
Okay, thank you.
Ms. Mather.
Thank you. In your report, you have a brief summary of the current status of our leverage in the portfolio. Could you address whether you think, given the current market conditions and where you see things moving, whether you think that our current policy remains appropriate, where you think there might be opportunities for change or recommendations to reconsider aspects of our leverage approach?
So here's a couple of observations. The key element that PCA looks to in analyzing leverage on your portfolio is not the loan to value percentage, but rather it's the debt service coverage ratio. And you're at close to 3 times debt service coverage. We consider that to be a safe level. And even if that were to decline because the cost of your debt went up or the amount of your debt went up, if it's north of 2.5, you're in an extremely good position in terms of defending your assets and not having to go back to the fund and ask for money to make the mortgage payments because the properties aren't throwing off enough cash flow. The benchmark element that comprises the largest part of the real estate benchmark is the Odyssey index of open-end performing properties. Their leverage ratio is approximately 22%. You're a little bit north of 30 at the moment. You also own assets that are higher risk for roughly 20% of your portfolio, and many of those assets have higher degrees of leverage, which influences it overall. So I would say you're at a comfortable level of leverage right now. And with interest rates going up, staff spends a lot of time with the individual managers at looking at the rolling off of your existing loans and the need to replace them in the future with loans that are likely to have higher interest rates. And staff over the last 3 years has become more active in managing the debt side of the real estate balance sheet, even though it's spread across a number of different managers, each of whom keeps their own mortgage relationships. So I think you're moving in a direction over time where you'll have more control and more input over the overall leverage, and I think that increased level of control and consolidation is going to be a positive thing. Right now, I don't see any storm clouds on the leverage front, notwithstanding that PCA clearly agrees that rates are going to go up. One of the things about leverage in the real estate community is a lot of it comes from regulated companies. And to the extent that these regulated companies have fewer regulations, and they look at real estate as being a relatively high-margin business, it's quite possible that notwithstanding rates are going up, regulations may be coming off, which allow regulated and non-regulated lenders to commit more capital to real estate lending, and that competition might be a bit of a brake on how quickly the rates rise for mortgages that you and your managers will be seeking.
Thank you.
Okay, there are no additional questions on this item. Thank you very much.
Thank you very much.
Report. And we now will move to Makita Investment Group. Bless you. Morning.
Steve McCourt, Makita Investment Group. We have two reviews for you today, infrastructure and private equity. We'll start with the infrastructure review, and I'll introduce Lisa Bacon, who's going to review that.
Lisa Bacon, Makita Investment Group. Good morning.
Good morning.
So for our review today, we're going to cover performance, a little bit of market commentary, and we have one item from November, from the November meeting that you asked us to take a little bit more of a look at and come back to you with. So on program performance, as Wilshire pointed out in their overview, the infrastructure program continues to perform well and significantly overperform the benchmark, looking at the one-year period, the six-year period, and really all trailing periods, with the difference anywhere from between 600 to almost 1,200 basis points. The program also is outperforming the assumed return for the ALM numbers that were not recently updated, but the ones that were in existence for the reporting period. We also took a look at the key parameters for policy compliance. With respect to implementation, we noted an increase in the NAV value of 10%, and with respect to the interim target, the program is at 1.2 compared to 1%. With respect to risk, the core value add and opportunistic distribution are compliant with policy. With respect to region, the U.S. developed, international developed, and emerging proportions are also compliant with policy ranges. With respect to loan to value and debt service coverage ratio, those two parameters are compliant with policies. With respect to segments and sectors, those are evaluated at the real asset program level, and so there's not a specific number with respect to the infrastructure program, but the allocations there are certainly consistent with the overall program numbers. With, again, on the final policy matter, with respect to the external manager, either an individual investment or an individual manager, those are compliant with the maximums as well. With respect to market commentary, as in the other asset classes, there is an awful lot of capital out there wanting to be deployed in this space. The numbers remain at all-time highs with respect to dry powder. Deal activity in the space also is at top levels with the fourth increase in a row with respect to annual values. Geographically, most of the capital is wanting to go into the North America and European space, the space that CalPERS also is targeting. With respect to deals in 2017, the distribution of actual deals is a little bit better distributed. Capital waiting to be deployed is about 80% targeting North America and Europe, whereas in the deals actually executed, 64% of the capital was put into North America and Europe, with the remaining in the balance of the world. With respect to risk level, Preqin doesn't exactly map it out the same way that you all do, but there's a loose mapping that we looked at. Most of the deals are in what Preqin calls secondary stage, which for all intents and purposes is core, essentially assets where there's no meaningful expansion, there's no fixing it, there's no turning it around. It's just an asset that's already performing and operating as you would expect it to. At the global level, about 3/4 of the deals have been in that space. On a region-by-region basis, it differs a little bit. Some regions have less core. Not many really have others. With respect to the greenfield, between 10 and 40% of the capital was deployed into the greenfield space, and about 10% deployed into brownfield. And with respect to these definitions, brownfield is an opportunity where it's an already existing asset, but where there's some, it might be an expansion, it might be a rehabilitation, something that is essentially in what we would consider to be the value add space. Notably, with respect to deal sizes in 2017, Preqin segments the market into four buckets. In all of those buckets, except the smallest, and so deals less than $100 million, the number of deals in that bucket decreased, but in every other bucket that they look at of the other three, the number of deals increased. And so as we saw last year and as we remarked on in November, the deals in general are getting larger on average. We took a look at the California space. There was a lot of activity to take a look at. However, most of the deals were in the energy sector, and in that sector, most of the deals were in renewable. That's not surprising. A lot of solar deals. When you look around the world, a lot of the renewables are in wind. We looked at the transportation sector. It really, the deals represents a lot of different sectors with respect to airports, roads, seaports, parking lot. There's a lot of activity in places in the U.S. and in Europe. There were notable deals in the water and wastewater sector. That's a sector in the United States where there's not a lot to see, since it's been usually held in the public sector, but in other parts of the world, there are a lot more private sector deals. And even in the U.S., there was one deal last year, and in the future going forward, we would expect to see some more maybe here and there. In the communications sector, most of the deal value was in Europe and Asia, and most of that was in a sort of standard telecommunications. In North America, there was a lot of internet and wireless deals to the extent that they occurred. With respect to outlook in 2018, as we noted in November, we expect more of the same. There is an awful lot of capital out there, which creates competition. I think the balance on that is there is an awful lot of deal flow, both new investments, new construction that are driven by needs for improvement in other places around the world, that are driven by urbanization and GDP growth. There are also a number of institutional commingled investment funds around the world that are coming up on their terms, and while the valuations were down over the maybe last year or two, a lot of managers extended their terms, and so now it's coming time to turn those over, and a number of the deals in the space last year reflected that dynamic. That is the end of my sort of new commentary. I do have comments on the staffing issues or questions that were raised last time, but I wanted to stop before I moved on to that.
Yeah, maybe it's appropriate to have a couple of questions. Now, one question I have is that you mentioned deal flow. With the president rolling out his infrastructure strategies this morning, I assume, is that going to have a negative impact of our opportunities to go out and create deals, because he's going to be allocating more money that perhaps may go to the PPP concept?
I think in the near term, it's not going to impact what you all are doing. It is going to take some time for those programs and that money to start flowing. I think, as we've also seen, there have been a number of starts and stops with the concept of a national infrastructure program. To the extent that it actually gets implemented the way that they're intending, on the one hand, there will be some net new capital. Some of the program will move capital around a bit, and so there may be some opportunities for you all to participate maybe where you might not have before, just because of the way the programs are implemented. I also think that at the scale that you all are operating, that a lot of the programs, a lot of the opportunities in that program, while there will be some very large projects, there'll also be a lot of smaller ones that really aren't going to be what you all were paying attention to anyway.
Okay, thank you. Mrs. Mather?
Well, thank you. You asked about the Trump plan. I was also going to ask about it. It does seem that it's fairly de minimis in terms of the amount of federal dollars actually being put into this plan, and it's relying heavily on municipal and state leverage or contributions. And so I was wondering whether you thought that there will actually be municipal and state level projects materializing, that this will this spur additional growth in those types of projects, which we have been interested in the past, but have not really seen significant deal flow in that regard. So,
to the extent that the program, in addition to the capital that it makes available or the capital that it tries to attract, to the extent that the processes and applications and different federal agencies and programs that need to be involved, to the extent that the whole program helps streamline some of that, then I think there's going to be more opportunity for certain projects that can attract capital to move along faster than they might otherwise have. At the same time, you're right, it does look like some of the source of capital is shifting around a bit, and so it really remains to be seen if at the local and state level, if they're prepared to do that, either from a fiscal perspective, if they're even able, or from a political perspective. Certainly on the East Coast, we've already seen some of the public governmental agencies balk at losing a federal contribution that seemingly was promised before.
Thank you.
And just add one thing, at least the note I read this morning on the first proposal, which will certainly not be the finished product, is a $200 billion of federal funds to support $1.5 trillion of ultimate investment. So your point is how the gap gets filled, and I think that's a huge question mark presently.
Okay, thank you. Mr. Slayton?
Thank you. You talk about power plants and primarily wind and solar plants that are coming online. Do you see that there is going to be a movement at all to any privatization of investor-owned utilities in the electric sector?
So far, I haven't seen that. There's certainly a lot of activity in the sector with new power plants, both investor-owned and with private private sector and P3s. Moving forward with the way the market dynamics evolve, there certainly could be some opportunities where investor-owned utilities where the economics work better if there's a joint venture, even maybe even something short of a full privatization.
Mm-hmm. Okay, thank you.
Okay, Ms. Bacon, you can proceed with your other part.
So in November, we talked a little bit about how the real asset program is set up with their staffing organization, and in particular, given our coverage with respect to the infrastructure program. And so we've had a chance since then to talk more with the staff and understand how they've been set up in the past, how they're organized now, and what their thoughts are moving forward. And so I wanted to summarize for you what we heard from them and what we think it means. So the Real Asset Program organizes their staffing around the 6 segments: commercial, consumer, essential, international, and specialized, within the new investments team and within the portfolio management group. And within the portfolio analytics, that's really more of a functional organization, and so those staff aren't in a commercial group or in an essential group. Within this structure, essentially what you have is a matrixed organization where you've got people in each of that are dedicated to each of the segments, but within those segments will work on real estate or infrastructure or timber to the extent that those segments include those. Of the 6 segments, of the 6 segments, 5 include at least one infrastructure asset category, and only one residential includes none. And so within the new investments team and within portfolio management group, essentially everybody but people dedicated to the residential category are working on or at least have the opportunity to work on some infrastructure. And certainly the deal flow in infrastructure is less than for real estate, just by virtue of the difference in the allocation there. This matrix structure lets the managers take advantage of individuals' expertise, lets them organize staff according to deal flow and workflow. And so as a result, there are some staff members who work on infrastructure more than they work on other types of things. And it certainly lets the managers take advantage of a number of the staff have extensive backgrounds in infrastructure investing, and it lets them work on the things that match best up with their past experience. So in general, this structure puts skilled people on the projects that they have experience to do and provides some benefits in cross-pollinization, or at least working on multiple sectors to apply those skill sets and expertise to the different sorts of investments. And at the same time, it doesn't, you don't end up with a group of people, a small group of people segregated who are not really integrated with the rest of the group.
Okay, Ms. Mather.
Thank you. Thank you very much for coming back to us on this. I know this is spurred by some of the questions that I was asking about the new structure. And so are you confident then that there is, that the team retains sufficient infrastructure expertise, and that infrastructure expertise is allocated appropriately to the one of the things I'm concerned about is, it's been very challenging, deal flow's been challenging, et cetera, but we're structurally not creating impediments to investing more heavily in infrastructure?
It doesn't look to me like there's any structural impediment. Okay. It looks like the staffing and the expertise level that can be deployed to infrastructure is an appropriate, a sufficient amount for the present time. I mean, to the extent that you're going to continue to grow that allocation in terms of what you're actually deploying, to the extent that deal flow there is takes more work to get the right kind of deal flow maybe than the deal flow that you've established for real estate, where there's already lots of managers and a lot of them work for you and only you. In the infrastructure space, you all are deploying a different model, and certainly working with managers directly and having separate accounts is going to support that. So moving forward, I guess, 3-5 years from now, I would expect to see more infrastructure skills, whether that's embodied in, 1 or 2 people specifically, or if it's the next 4 people you hire have some infrastructure experience and are, willing and able and eager to work on those sorts of things. This matrix structure can support your program moving forward to the extent that it's taken advantage of.
Okay, thank you.
Okay, thank you. No further questions. Mr. McCart, next.
Great, so we're going to shift on to our private equity report. Great, and I'll start on page 3 with a very quick summary, and then hand it over to Steve to talk about the private equity marketplace and the structure of the CalPERS portfolio, before taking it back to discuss performance at the end. As you've seen with all of your asset classes for 2017, private equity was no exception in producing strong absolute returns. Your value of your portfolio on a net asset value basis increased to $26.7 billion. That's a little under $1 billion more than it was 6 months ago, despite the fact that you had nearly $2 billion of cash flow out of the program back to you. As a mature program, that cash outflow is a normal part of your program. That asset level at the end of the year represented 7.6% of your entire plan, so 40 basis points below your long-term target. As Steve will review, the portfolio is very well diversified by vintage year, by sector. 62% of the portfolio is invested in buyout strategies, which are the most common strategies in the private equity space. The program, I'll note as well, has been a bit more active, particularly in the second half of this year. Staff has completed 8 commitments totaling $2.4 billion in the last 6 months of the year, and seems to be on a pace to exceed the $4 billion target for this fiscal year, which is a nice change in trend from the past couple of years.
Steve Hart, Makita Investment Group. So wanted to take a bit of time here to go through a couple of slides quickly on the private equity marketplace and talk about a couple of segments. The first segment talking about the private equity segment marketplace, and primarily the buyouts. So what we've noticed here in 2016 and into 2017 is a general slowdown in the marketplace. There's just less transactions taking place than had been happening in the prior couple of years. There's been a fewer mega deals. There's some discussion as to kind of why that's been happening. Part of it might be, as I discussed last time, kind of the follow through, the liquidation ultimately of the investments that were done 2004, 2005, 2006. There was the big peak markets that's essentially rolling off, and we're kind of coming back into some of the investments that were done more recently. That being said, the cost of investments remains high at peak levels. That's been maintained. We're seeing that on average 10.5 multiple of EBITDA has been maintained in the marketplace, and that is a new peak record. In addition to, or on the other side of the coin from the new investments being done is the exit activity, and that also is reported down. These numbers through the third quarter of 2017, at the time we did the report, that wasn't, the full year wasn't yet ready, but we can see that the pace of exits has slowed down. Another part of this is that the average age of the investments within the portfolios has continued to increase. Secondary buyouts remain a strong portion of the exit path for private equity investments. 50% now. In the past several years, that path of exit has become more popular compared to corporate acquisitions, has grown from 40% now to 50%, and expect that's likely to continue to go apace. IPOs remain a relatively small portion of the exit path. Turning to venture capital, a little bit different than the buyouts market, where the amount of capital deployed in venture capital has increased to a new record in 2017, $84 billion. The number of investments has gone down slightly compared to 2016, and is down pretty meaningfully from 2014-15. So obviously what that means is that the average size of investments has gone up. And that's reflected a little bit on the next page here, where we show the trend lines of the round sizes in venture capital, and showing the different stages of the investments in venture capital. So the bottom line there, the seed stage, where the companies are just getting started, middle stage there, and then the late stage when obviously capital is, the companies are larger, tends to take more capital. Talking about exits in the venture capital marketplace, that also has come down from the peaks, but remains quite high compared to the last several years. Been pretty high, much higher than it was in 2008 and 2009. Again, the numbers have decreased, and again, that means that the average exit size has been somewhat larger. In terms of path for how the venture exits are taking place, noting there that different from what might be commonly believed, IPOs, again here, remain a very small portion of the amount of value that's being created in venture portfolios. Most of these companies are acquired, whether by another venture-backed company or someone in the marketplace, a competitor. The buyouts are increasing in number. What that refers to generally is that another private equity firm is buying, that's moving from a venture capital space to a buyout space, and seeing it especially in the software area, where there's a lot of interest by buyout companies to invest in software companies that have proven subscription-based revenue models, become quite leverageable, and they've been quite popular. It's mentioned by Wilshire earlier that the fundraising cycle in private equity has remained very strong. Again, these are through third quarter, but through the full year of 2017, I believe it hit a new record in terms of total funds raised. This is largely driven by some of the large capitalization funds that have been quite popular. So on the next page here, showing the trend lines in the average and the median size of funds, can see that the average fund size is reaching what had been achieved in 2007. So a lot of the fundraising taking place has been driven by some of the very large funds. Oh, this is still the so page here, just reviewing the private equity program here, showing the allocation of the program amongst the different strategies, and you can see that the program remains in line with all of its allocation ranges. The credit is getting a little bit on the small side, and that has shrunk down somewhat with the years. Looking more closely at the buyouts, can see that the large and mega funds are a very large percentage of the buyouts exposure, with middle markets being a strong second place on that, very little exposure to small buyouts. In the credit sector, again, the portfolio does not move much from each of our reports. The vast majority of the portfolio here is in the distressed market area. As you'd expect, the exposure from geography is quite strongly tilted to U.S.-based managers, with Europe being next and emerging markets next. Looking underlying through the portfolio company level, that there are a number of U.S. based managers that make investments outside of the United States. So looking through at the underlying companies, United States exposure remains quite strong at 60%, and followed by Europe. This chart doesn't change very much either from our reports. Just looking at the amount of commitments by vintage years, there were a lot of commitments in the 2006, 7, and 8 timeframe, and that's going to take a little bit of time rolling off. But looking at the exposure, sorry, I hit the wrong button. Looking at the exposure from an uncalled capital perspective is rolling more forward to the more recent vintages, and that the exposure that's in those older vintages is really rolling off now. Funds are the dominant structure through which CalPERS has its exposure to the private equity sector, followed by the customized investment accounts. And looking through to the unfunded, it tilts even further to the funds. In terms of the top 5 managers, this list is, I believe, the same list of managers. There was a bit of a movement around as the 2 commitments to the Carlyle organization took place, moved them up, I think, from 4th to 2nd. But the top 5 managers account for about 30% of the exposure in the private markets portfolio. You can see here in, this is the chart showing the cash flows in the program, and what the line shows is the net difference between the contributions and distributions with the net cash flows. And you can see since 2011, nearly $30 billion of capital has come back into the program. So the contributions that were made in the years previous have been coming back, and as those managers have been exiting the portfolio. So while there's new commitments being made, those are being drawn down, and that's the blue bar showing that there's contributions to the program, but there's been more capital coming back than has been drawn down. Although that has begun to slow, it was still a net positive inflow of cash, which is as you can see on the next page here, actually showing what's happened in the portfolio program value change, as Steve had mentioned, $800 million net value increase in the portfolio, but that is based upon the change in cash contribution distribution, which was a return of capital, so shrinking the program size, but had the whole overall program had a $2.5 billion value increase, or $4 billion for the whole year.
So the summary performance is shown on page 27. For the 1-year period, the private equity program returned 18%. So a very strong absolute return. For those of you that have been familiar with private equity for some time, it's normal for private equity to lag public markets when markets go way up. 2017 can be characterized as a way up market. So your program underperformed its policy benchmark, which is the public markets plus 300 basis points by 4.9 percentage points, and that's a reasonable expectation for a strong up year. I'll note just for context that the average private equity return for the year using the same endpoints here, and the Cambridge Associates Private Equity Index, which is the industry standard, was 16.5%. So your program did outperform the average private equity investor. It, of course, outperformed the capital market assumption for the asset class as well. Going back 10 years, the program returned 9.1% versus the policy index of 13.2%. Within the program, looking at the types of vehicles where performance is coming from, most of your capital is invested in fund structures, and for the year, funds were up 18.7%. You can see the co-investment program returned 50% for the year. Major message I would send there is that co-investments tend to be lumpy, so you get your returns a bit more idiosyncratically, and fortunately this was a strong idiosyncratic year for co-investments. Fund of funds have generally produced lower returns for the year and also over time. And the final slide I'll go through is just performance by geography. The major item to note here is that for the 1 year period, Europe and developed Asia had very strong returns. Part of that can be attributed to execution of investment strategy within those regions, but we also had a declining dollar during the year. So when the currency in those regions appreciates relative to the dollar, your return is generally higher as a consequence. And so the dollar worked in your favor in the private equity program this year. And with that, we'll conclude our report and happy to take any questions.
Yeah. On your earlier chart, you identified that our portfolio value was $26.7 billion, but you also indicated that the unfunded commitment, when you add that to the value of the portfolio, it goes up to $40 billion.
Correct.
So when I look at unfunded commitment, I think of off-balance sheet commitments. You know, when you're looking at a number, it's not the real number because you got all this money that you owe out here. So 2 questions related to that. Is there a policy? Do we have a policy on how big that unfunded commitment can go? And number 2, is that uncommitment number, is that based on a prior commitment dollar value, or is it waiting to roll out and then it's going to be a new dollar value? You know what I mean? Because you can make a commitment that you're going to allocate $2 billion for a project, or you can make a commitment that you're going to allocate the necessary funds to the project. So is it the number that's in the initial commitment, or is it going to be a larger number?
So I'll say a couple of points. So there is no there's no direct policy restraint on the amount of commitments. The staff, every time when they review an investment opportunity, will check and see how that opportunity fits in with the exposures that they have, and they roll forward and say, you know, for the different sectors, for the different manager exposure, are we within compliance on that? So there's not an overall number that says, do we have too much unfunded capital, or do we track that? Your second question on regards to the commitments. So what that is that when staff makes a commitment to a particular fund, let's say, you know, $200 million, then that is essentially the opportunity for that manager to make capital calls over time to be able to invest into underlying companies over a designated time period, between usually is typically about 5 years. And sometimes not all that capital is called at the end of the day. It depends on whether they find the transactions, but typically close to somewhere between 90% or more of that would get called within the time frame. And so that the number that you see there, about $19 billion of aggregate unfunded commitments, will go up and down, go down as capital is called, down as commitment periods end, but increase as staff makes additional commitments to private market funds.
But at this point in time, that's the maximum exposure that you could have if every general partner called all their capital the following day. So there's no additional amount that you'd be obligated to fund beyond that. And the other thing I would highlight is relative to other programs, the amount of unfunded commitments you have is actually relatively small compared to your net asset value. One could argue that you've underallocated to the asset class for the last several years while you've had a lot of capital come back from prior vintages. So it's normal for unfunded commitments to be to match, if not exceed, the net asset value in the program. Your level of unfunded commitments is actually as a ratio on the low side today.
Okay, thank you. Mrs. Mather?
Thank you. Yeah, I note that Sequoia announced a very large venture fund, an $8 billion fund, I think. And I'm wondering whether you see that as indicative of any trend or shift in the venture market, and whether you think that has, will result in any opportunities for us. As you know, we've had a very small allocation to venture, in part because it's such a small space too. But anyway, just curious about what if you think that is indicative of anything bigger and what that might mean for CalPERS.
Sure. So that Sequoia program, the Growth Fund, is reflective of a trend where companies have been staying private for longer, and that they have been using that that approach and looking at different sources of capital to extend their growth of their businesses. So that had come from hedge funds, had come from mutual funds such as Fidelity and Wellington that have allocated a portion of their mutual funds to this space. I think that firms like Sequoia and others want to continue to participate. Their general thought is, we've started this company from beginning, we do like the company, let's continue to fund it. So in terms of opportunity for CalPERS, being able to deploy large amounts of capital to interesting, exciting companies is a potential interesting area. I think that there are at least two major questions. One is the valuation at which those investments are being made, and number two, ultimately, what will be the exit? At some point, how will liquidity be arrived at with these companies? They're becoming, in many cases, difficult to do an IPO on with that size. And in some cases, the businesses are not particularly diversified. They're not as robust as maybe other ones. They just haven't been around as long. Their business models, they work in businesses that have business models that are changing pretty rapidly. So, when you go into the IPO market and investors are looking at that with a different lens, that would have to be carefully considered.
Okay, thank you.
Ms. Yee?
Thank you, Mr. Chairman. Thank you for the report. I was curious as to your sense of our decision to limit or restrict the number of private equity managers, what the consequence has been of that, whether you think we're missing out on potential investments, or do you think it's had a positive effect in terms of really leading to greater access to more attractive investments?
So this is a topic been asked to kind of discuss in closed session, but in general, working with staff to discuss and review this particular topic with the idea of the particular objectives of deployment of capital, as well as cost and transparency and diversification in the portfolio. Thinking through these factors to assess what is an appropriate strategy for this, and whether it's continuation of 30, whether it's other options, whether it's a different number, or thinking about things. So that's what we're doing, is working with staff to think about those issues.
Okay, all right.
Okay, seeing no additional questions, thank you for the report. And we're going to recess now And we have to go across the street for 30 minutes and then come back for lunch maybe for 45 minutes. So let's reconvene at 1:45. Okay? Long break here. 30 minutes for the picture.